Welcome to vTalkInsight, Allocator's Lens Daily for April 1st, 2026. Cross-asset pricing is starting the new month with an extraordinary oil shock, shifting rate expectations, and a powerful dollar all pulling portfolios in different directions. The key question now is whether this energy-driven inflation scare turns into a broader growth shock or remains a manageable headwind for risk assets. In equities, the month closes with a sharp reminder of downside risk after one of the weakest monthly performances since the major crises. Even though the final session delivered a near 3% rebound and volatility has dropped from above 30 to the mid-20s. Large cap indices have corrected hard, but the bigger story is under the surface. Momentum trades in semiconductors and other technology have been hit particularly hard, and small caps are lagging as markets increasingly price out a clean, soft landing narrative and lean towards slower growth. Leadership has rotated decisively toward energy, utilities, and basic resources as the oil shock reprices earnings power across sectors. Big tech is no longer behaving like a defensive haven. Major platforms have sold off, and concerns are building around higher capital intensity and more uncertain long-term cash flows, even though select AI beneficiaries still attract capital, highlighted by high-profile moves such as a large AI investment into photonic silicon for faster data transfer. At the same time, retail buyers continue to buy the dip, keeping liquidity in the system and supporting sharp intraday reversals despite the macro shock. From a regional lens, the long-standing U.S. equity premium is finally starting to erode. U.S. equities recently accounted for more than 60% of global market value, well above long-run averages, and that dominance plus stretch valuations has left more room for multiple compression as growth expectations are trimmed. European markets, by contrast, trade around 14 times earnings, broadly in line with history, but consensus profit growth near 9% may prove optimistic, with several commentators seeing something closer to 5 or 6% as more realistic given the energy squeeze. Fundamentals are not uniformly negative, which makes the equity outlook more nuanced. Earnings expectations for the S&P 500 have actually improved, with upgrades concentrated in energy and parts of hyperscale technology. Airlines are raising full-year guidance on robust demand even as they face higher fuel costs. And one major house still expects risk assets to stay broadly resilient as long as oil trades roughly in an $80 to $100 range. The risk case is clear, though. If crude were to spike toward $140 or beyond, the resulting demand shock and potential emergency rate cuts would likely force a deeper reset in equity valuations, especially in cyclical and highly levered segments. That tension between still solid earnings and an oil-driven growth scare sets the stage for what is happening in rates. Rates markets enter April after a violent repricing higher in yields across the U.S., Europe, the UK, and Japan, taking many 10-year benchmarks to multi-year highs before a late-month rally. The tone has shifted compared with earlier in the week. Instead of obsessing over another inflation wave, bond traders are increasingly focused on what sustained energy shocks due to growth. Federal Reserve officials stress that long-term inflation expectations remain anchored and that monetary policy works with a lag, so they are reluctant to react aggressively to a supply-driven oil spike that they cannot fully control. Against that backdrop, the front end of developed market government curves is attracting attention. Several desks view the recent surge in short-dated yields as overdone, arguing that with inflation expectations contained and policy rates already restrictive, current levels allow allocators to lock in attractive income without relying on big capital gains. At the same time, persistent fiscal deficits, talk of much larger defense budgets, and questions about who will absorb heavy issuance leave more uncertainty at the long end, especially as traditional assumptions that treasuries automatically hedge inflation shocks are being challenged by repeated supply disruptions. The modal path still sees the Fed and other major central banks on hold near term, with a probability of modest easing later in the year if growth slows and oil stabilizes. But scenario analysis is widening. If crude spikes well beyond $140 and stays there, some analysts see scope for as much as 100 basis points of rate cuts to counter a potential recession, which would mean falling yields for uncomfortable reasons. Upcoming inflation data, auction demand, and the evolution of Middle East supply routes will be critical for how the curve trades from here, and they will feed directly into credit conditions. Credit is the transmission channel where higher rates, slower growth, and the energy shock all meet. Despite the equity drawdown and big moves in government bonds, public credit spreads remain tight, offering only modest extra yield for taking credit risk at a time when the macro outlook is getting murkier. That leaves little cushion if growth data or earnings disappoint, especially for more cyclical borrowers and commodity importing regions facing higher fuel costs. There's a clear quality bias in current commentary. Long-duration U.S. investment-grade credit is seen as relatively resilient, supported by a positive technical backdrop and the appeal of locking in known cash flows, particularly compared with riskier parts of the fixed income spectrum. By contrast, tight spreads in high yield and parts of private credit sit uncomfortably alongside reports of rising funding costs, sector-specific stresses, and mounting scrutiny of leverage in more opaque vehicles. Banks sit at the center of this story. Some UK lenders have just received relief as expected compensation payouts on mis-sold car loans were revised lower, but others still face significant challenges, underscoring how uneven the landscape is. Upcoming U.S. bank earnings and manufacturing surveys will be important markers for margin pressure, loan growth, and early default trends. How those signals evolve will shape whether credit stays a quiet outperformer or finally adjusts to the higher volatility already visible in equities. In foreign exchange, the U.S. dollar has just delivered its strongest monthly performance in several years, reasserting its role as the dominant safe haven. The combination of geopolitical tension, a severe energy shock centered outside U.S. borders, and relative domestic resilience has pulled capital toward dollar assets, while many Asian and European economies face greater inflation and growth headwinds from higher imported energy prices. Several commentators expect that dynamic to continue, arguing that markets still underestimate how much higher energy costs and better U.S. growth prospects can support the dollar. The picture is not one way, however. U.S. and China are exploring more structured mechanisms to manage sensitive trade flows and secure rare earth supplies, which could reduce tail risks around the bilateral relationship even as broader trade tensions linger. If oil prices surge further and tip more of the global economy toward recession, ongoing dollar strength will be driven by bad reasons, reinforcing stress in weaker credits, whereas a durable de-escalation in the Middle East and a faster-than-expected shift by the Fed toward easing could eventually cap the dollar's upside. That brings us back to commodities, the fulcrum of this entire regime. Commodities remain the pivot point, and oil is at the center. Brent crude has climbed roughly 50% from pre-conflict levels in a single month, one of the largest rallies on record, as disruptions around the Strait of Hormuz leave around 20 million barrels per day stranded and push refined fuel markets into acute shortage. Gasoline and diesel prices have jumped above $4 per gallon in the U.S. and are spiking across Europe and Asia, feeding directly into headline inflation and forcing some governments to contemplate duty cuts, demand restraints, and other emergency measures. The scenario range for crude is unusually wide. On one side, some analysts argue that with inventories still providing a short-term buffer and global growth reasonably solid, the macro hit is manageable as long as oil averages somewhere between about $80 and $100. Others see a higher base case, with forecasts around $125 and scope for spikes toward $150 if Gulf supply remains constrained, while a severe escalation and prolonged closure of key waterways could briefly drive prices close to $200, raising clear global recession risk. Beyond oil, the commodity complex sends mixed but important signals. Gold screens well in this environment, with persistent geopolitical tension and large fiscal deficits expected to support its role as a structural store of value, especially as traditional hedges like long-term sovereign bonds struggle to offset inflation shocks. Industrial metals tell a different story. Copper prices have rolled over amid reports of weaker client demand and no inventory build, echoing the growth worries that are now showing up in rates. Rerouted energy shipments, a growing premium on gas reserves outside the Middle East, and the search for real asset hedges all underscore how central commodities are to the next phase of cross-asset repricing. Pulling it all together, equities are recalibrating from a soft landing narrative toward an energy-driven growth scare, even as select pockets like energy, some AI-related names, and travel and leisure still show earnings momentum. Rates markets have swung from a pure inflation story to a more balanced mix of growth concerns and policy patience, Front-end yields look rich in income terms, and traditional duration hedges are behaving less reliably. Credit spreads remain tight relative to both volatility and the macro uncertainty. The dollar is strong on safe haven and relative growth dynamics, and commodities, led by oil and gold, are the fulcrum of the stagflation debate. For allocators, the key watch points now are the path of Middle East tensions and crude prices, the evolution of upcoming inflation prints, bank and cyclical earnings guidance, and how the dollar responds if growth abroad weakens further. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.